Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. I would additionally note that the participants in today's webcast meeting are joining remotely. So if we experience any technical difficulties, I ask for your patience in advance. Before we turn to our first agenda item, I would like to note that the NCUA Board has unanimously voted to postpone the release of the agency's draft 2022 to 2026 strategic plan for public comment. The additional time will give board offices the time needed to reach consensus on the agency's proposed strategic goals and priorities. I want to thank the other board members for their willingness to work with me on this, as well as for their good ideas as we've been putting this document together. Now, let's turn to the first item on our agenda today, a request for information and comment about digital assets and related technologies. Staff presenting are Dr. Scott Borger, Operations Research Analyst, Office of National Examinations and Supervision, and Tom Zells, Senior Staff Attorney, Office of General Counsel. Scott and Tom, you may begin when you are ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. This is Scott Borger from the Office of National Examinations and Supervision. Attorney Tom Zells and I are here today to recommend the board issue a request for information and comment that solicits stakeholder feedback regarding the current and potential impact of activities connected to digital assets and related technologies on the credit union industry. Decentralized finance, also known as DeFi, is the broad category of applications adopting peer-to-peer networks, distributed ledger technology, and related uses such as smart contracts to create digital assets like cryptocurrency and crypto assets, starting in settlement systems, identity management systems, and record retention systems. Distributed ledger technology, also known by its acronym DLT, is the digital process to record transactions that are behind many of these innovations. Blockchains are one type of distributed ledger. In a blockchain, a chronological record of all the transactions is created and stored by sequentially grouping all the transactions together in blocks. Digital assets can be transferred between two people without an intermediary. However, as a practical matter, most members of the public do not have the means of converting dollars into digital assets on their own. Software developers and entrepreneurs have created exchanges to facilitate the exchange of dollars for digital assets. Digital wallets provide consumers the means to store their encryption keys required to verify ownership of their digital assets. Since the introduction of DLT, thousands of projects have used the technology to lower the cost of verifying ownership, storing distributed data, or tracking information. For example, the projects have covered tracking ownership in national land registries to tracking the history of a product in the food supply chain. While decentralized finance applications offer a number of potential benefits and opportunities for the credit union system, they also present several risks. For example, one, the permanent nature of transactions necessitates questions about consumer recourse for fraudulent financial activities. Two, the ability to source funds for new projects has the downside of individuals or groups manipulating the price of tokens. Three, the storage of digital assets poses risks of lost or stolen cryptographic keys. And four, the ability to transfer value through peer-to-peer networks creates unregulated money transmitters that can provide liquidity to those who want to launder money or participate in tax avoidance schemes. This request for information aims to engage the broad credit union industry and other stakeholders to learn how emerging DLT and DeFi applications are viewed and used. We hope to learn how the credit union community is using these emerging technologies and gain additional feedback as to the role the NCUA can play in safeguarding the financial system and consumers in the context of these emerging technologies. I will now turn it over to Tom Zells from the Office of General Counsel to discuss some of the questions that we are asking in this request for information.
Thank you, Scott. In order to continue to fulfill its mandate to maintain a safe and sound credit union system and protect credit union members, The NCUA is working to better understand the implications of these technological changes and the associated benefits or challenges that may exist. As Scott stated, the request seeks comment on the current and potential impact of activities related to distributed ledger technology and decentralized finance on the credit union system. The request broadly seeks stakeholder feedback, including current and potential uses. While the request contains a number of specific questions, I want to emphasize that commenters are also encouraged to discuss any and all relevant issues they believe the NCUA should consider with respect to these technologies and related matters. I also want to stress that this request for information does not modify any existing requirements applicable to federally insured credit unions and does not grant any new authorities or limit any existing authorities. The request for information also does not speak to the permissibility or impermissibility of any specific activity. The request itself addresses 5 broad categories of questions. First, questions regarding usage in the marketplace. Second, operational questions. Third, questions regarding risk and compliance management. Fourth, questions regarding supervision and activities. And finally, fifth, questions regarding share insurance and resolution. With that, we will be happy to answer any questions you may have.
Thank you, Scott and Tom, for your presentation. Before I deliver my remarks, I would like to thank Vice Chairman Hoffman for renewing the agency's focus on the issues of cryptocurrency, digital assets, and other related innovations. His insights and leadership shaped the request before us today, and as such, I would like to recognize Vice Chairman Hoffman first.
Thank you, Mr. Chairman. I've told you before, but I'll put it on the record here. I know it's unusual for someone besides the chairman to speak first, so know the gesture is appreciated. Thanks to Board Member Hood as well for his support and contribution on this topic. Last year during my Senate nomination process, I mentioned that one of my priorities was blockchain technology. So I'm personally gratified to see us moving on this. The context at the hearing was about last year's stimulus payments and the fact that about half the payments, 88 million of them, took weeks to get to people because they were sent via old-fashioned paper checks, paper envelopes, to mailing addresses that were often years old. Hopefully in the future, digital assets and digital wallets will make it much easier the next time we need to send out badly needed emergency cash. But regardless of what I've made a priority, NCUA would obviously have addressed this issue sooner rather than later. When it comes to cryptocurrencies and blockchain, it feels like we're still at the beginning. If we were talking about the internet, this might be analogous to the dial-up AOL era. I'm pleased to see agreement at NCUA that early regulatory clarity is better than waiting until credit unions are left behind in a changing marketplace. The last thing we want is for credit unions to go the way of Blockbuster Video because their regulator didn't allow them to compete. We've already seen assets move out of the traditional financial sector, and young people in particular are getting used to using new fintech firms for their financial needs. Meanwhile, credit unions are ready to gain market share in services like remittances if we allow them to try new, easier, cheaper technologies. So folks, please submit any and all ideas whenever you think of them. I've already talked to industry groups that have been working on responses to send us, partly because some of these groups are already responding to a similar request from the FDIC. I'll note that today's request for information has a catch-all question that basically says, regardless of what's in this document, send us anything you think NCUA can do that would help. I want to make sure that nobody can say that they didn't send us an idea because NCUA didn't ask a particular question. Step back from credit unions for a moment. The US is in a race to be the center of this new industry, much the way this country did so well with the internet economy. And while I'm a Republican, I feel compelled to mention that one reason America dominated the internet industry is because 25 years ago, Bill Clinton's White House published principles that said the government in general will not interfere with the growth of this new technology, the internet. Millions of Americans have jobs today due to that early guidance from the federal government. It's possible that we'll get similar benefits from the blockchain industry, provided we give our entrepreneurs and investors the clarity they need. We want people to make products designed for credit unions so that the current system can adapt and thrive. And as a fiduciary of the Share Insurance Fund, it's my obligation to help make that happen. Lastly, today's request for information dovetails nicely with NCUA's mission around access and inclusion. That concludes my remarks, and I just have one question, which is, can our team review exactly how and when people can reply to this RFI?
Sure. So this is Tom Zells, and I can take that. We have the request for information, which will be posted in the Federal Register, and it will be published for a 60-day comment period from that time of publication. Comments can be submitted to regulations.gov. There's a pretty simple process for commenters to be able to do that. And I believe we are also still soliciting comments by mail as well if commenters prefer to do that. But I think the bulk of them typically use regulations.gov.
Appreciate that. But normal people don't go to the Federal Register. Is this going to be on our website, and when?
Yes, it will, and I would anticipate that it will be posted today, but I can work to confirm that.
All right, so sometime tonight until about September 21st, that is the time, September 21st, that's the time frame. And if I can make one request to tweet out the link to as well at the NCUA, our Twitter account. We just want to make it as accessible as possible. That concludes my remarks. Back to you, Mr. Chairman.
Thank you so much, Vice Chairman Hopman, and I completely agree with you on making this widely known and soliciting as many comments as we can get. And again, Scott and Tom, thank you for your good work on this request for information. This agenda item builds on the past work of the agency, including former Chairman McWaters, who established both the cryptocurrency and emerging technologies and fintech working groups in 2018. Mr. McWaters saw the potential for these technologies to create greater efficiency within the financial services sector and convenience for consumers, as the Vice Chairman has pointed out. He also saw the need to understand the potential risks that could emerge from the adoption of such technology. Cryptocurrency, digital assets, blockchain, and decentralized finance are no longer solely used in Silicon Valley and high finance. Global markets have quickly embraced these tools, altering the way that people perceive and engage in financial services transactions and commerce. The ongoing COVID-19 pandemic has also only accelerated the rate of adoption of these products and technologies. In just over a decade, cryptocurrency has exploded to nearly 6,000 forms worldwide. What is more, distributed ledger technology is lowering the cost of transactions and verifying ownership. And the widespread use of peer-to-peer lending and payment applications means that billions of dollars can cross the country or the world in seconds without a depository institution serving as an intermediary. While we should recognize and harness the potential opportunities these products and technologies offer, we must also recognize the potential risks to the credit union system and the broader financial services sector and develop appropriate guardrails. There are several concerns associated with these technologies, including Bank Secrecy Act and anti-money laundering compliance, consumer financial protection, equity and fairness, and even the potential coverage of these products by the National Credit Union Share Insurance Fund, among others. The NCUA is also not alone in looking at these issues. Regulators across the financial services sector are examining issues related to the benefits, risks, and regulatory treatment of decentralized finance products and cryptocurrencies. Any action that the NCUA board ultimately takes in this area should consider those efforts, and where possible, our actions should be coordinated with other regulatory bodies to ensure uniformity and to prevent regulatory arbitrage. This request is the next logical step in laying the groundwork for federally insured credit unions to leverage these innovations. But we must also recognize that things continue to evolve quickly. Therefore, any policy related to cryptocurrency, digital assets, and other related technologies cannot solely come from the NCUA. The pace of technological change means that any top-down approach could inadvertently miss the mark or stifle innovation and prevent credit unions from embracing this technology or competing against non-bank actors, increasingly gaining market share in areas where banks and credit unions have traditionally operated in. As such, I encourage credit unions, vendors, and all other interested stakeholders in the cooperative credit union system to review this request and to share their views. Tell us what you plan to do with these systems and technology to serve your members and meet business objectives. We especially need to understand what limitations could affect your ability to adopt these technologies and what risks they could pose, so that we can adopt appropriate guardrails to protect the financial well-being of members and the safety and soundness of credit unions. Scott and Tom, I do have two questions. First, how important is it that credit unions provide us information on what they intend to do with these products?
Thank you, Chairman Harper. This is Tom Zels, and I can take this. It's very important that credit unions provide us this information, and your remarks perfectly articulated why. This is a rapidly evolving area in which credit unions themselves are going to be the ones most familiar with and responding to member demands. To the extent that questions arise regarding how the financial system's existing guardrails apply to these technologies and products, regulators can work to provide clarity and tailoring. NCUA will always work to fulfill its mission and address any risk to credit unions and consumers. However, as you stated, a solely top-down approach, where regulators try to anticipate consumer market demand and provide clarity to address those expectations, may not be the most effective manner to fulfill this mission. Without credit union input, any guidance or further action driven solely by the NCUA may not align perfectly with the questions and issues that credit unions are actually encountering. This concludes my response.
Thank you so much, Tom, for that. And I would, we are in the process of Board Member Hood previously worked to create a financial technology and innovation unit within the NCUA. We are in the process of hiring somebody to that. And that's going to be a first point of call for credit unions as they are working to develop that. Tom, or this may actually be for you, Scott, based on your research, how dependent will credit unions be on CUSOs and other third parties to support their operations in digital asset and decentralized finance?
Thank you, Chairman Harper. So this is Scott Borger. It's a great question. So credit unions often hear from their members about their desires related to new technologies, but credit unions aren't necessarily the developer of these technologies. Instead, they'll often turn to their CUSOs for technological solutions. In this arena, where the size of the network is important, the CUSOs might turn to other third-party vendors to support their native solutions for credit unions, or to connect credit unions to the broader community using decentralized applications. We're certainly interested to hear from the industry how they might use CUSOs and other third parties to support these operations. This concludes my remarks.
Thank you for those observations, Scott. I am also concerned about the expansion of these services and operations into CUSOs and other third parties, which could pose significant risk to the broader financial system without the NCUA having the authority to oversee vendors. The continued transfer of operations to CUSOs and other third parties diminishes the ability of the NCUA to accurately assess all risks present in the credit union system. To address this issue, the Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's own Inspector General have all called on Congress to consider legislation to provide the agency with examination and enforcement authority over third-party vendors. I very much agree that we need to close this regulatory blind spot. Without this authority, thousands of credit unions, millions of credit union members, and billions of dollars in credit union assets are potentially exposed to unnecessary risks. That said, Scott and Tom, the request that you have developed here strikes an appropriate balance between understanding the potential benefits of digital assets and related technology and gaining insights into potential risks these innovations may pose to credit unions and where potential safeguards should be developed. Thank you again for your hard work on this. That concludes my remarks, and now I recognize Board Member Hood for his comments.
Great, thank you, Mr. Chairman. And I'd also like to thank Scott and Tom for today's presentation. I am extremely excited and pleased about today's RFI because I've been a longtime supporter of innovation, because I think through financial innovation comes greater access and opportunity for helping underserved and marginalized communities. I think it's that intentionality of not innovating just because it's the new cool thing to do, but because we are looking at how do we use and deploy these particular tools and technologies that are out there to assist our member owners in reaching their full economic potential. And most notably, I want our smaller credit unions to really be able to use some of these tools because it can help them with greater operational efficiency, reduce costs, while at the same time better serving their member owners. When I speak today about today's RFI, I want to begin with an anecdote. In fact, a few months ago, I spoke with the president of a financial institution in Charlottesville, Virginia. In fact, it's a relatively small one of about $300 million. Earlier this year, they started providing Bitcoin access at their branch locations and ATMs. Now, that is not exactly something you expect to hear from a small financial institution, but ladies and gentlemen, their customers had expressed interest in cryptocurrency, so the bank leadership decided to experiment with Bitcoin to gauge the response. As this president put it, they wanted to prove that smaller institutions could be just as innovative as the big national players. Now, time will tell how this plays out. And for now, we should view Bitcoin as an experiment in customer service until we have more data. But I'm impressed that this small institution has taken such a forward-leaning approach because that's an important part of being competitive in today's dynamic marketplace. Now, let me pause to clarify. I'm not saying that all of our 5,000 plus credit unions and regulated entities should rush into Bitcoin, but I am encouraging credit unions to look carefully at technological tools, whether it's cryptocurrencies, distributed ledgers, digital payment platforms, or blockchain applications, or even financial data aggregation. The list goes on and on and on. And I think very hard about how they may or may not fit into your business model. So credit unions, we're going to ask you and through this RFI to look at how these evolving technologies can fit and play a role in your technology, in your day-to-day operations and technological needs. And please let us know that. I also want to publicly thank NCUA Vice Chairman Hauptman as well for leading on digital asset issues at the NCUA. An undeniable challenge that credit unions face, and all financial services providers for that matter, is how to continue growing and prospering in a crowded marketplace. And one way to compete effectively, as the small institution I referenced in Virginia recognized, is by looking very closely at these fintech solutions and determining how they can be of value to your member owners. It's often been the case that regulators have ended up behind the curve on confronting technological changes. I'm determined, along with my fellow colleagues at the board, to not let the NCUA get caught flat-footed by the rapidly changing technology marketplace. As an agency, we are working diligently to do more to focus on the regulatory and supervisory needs related to fintech, as evidenced by our soon-to-be released merit examination system. The measurement, examination, and risk identification tool is one of the things that we're doing to show that we're not just advocating for you all to embrace fintech, we also are looking through RegTech and SupTech solutions as well. We recognize these technologies are going to play a growing role in financial services in the years to come. So we want to be prepared to ensure that we are effectively integrating them with the needs of credit unions and credit unions member owners. I'd like to thank my fellow board members for in the last meeting we had in December, where we were able to approve the new position that the chairman referenced. Yes, we have gotten a very robust set of applications for individuals who wish to be our first Director of Innovation and Access. And I look forward to that person continuing to work with all of you in the industry. I look forward to us getting the comments, because one of the first few things that this person will do, he or she, will be looking at some of the comments and working with us to come up with meaningful solutions as to how do we look at any potential rules in the days to come around digital assets and technologies. I also would just like to thank you all for moving forward with today's rules. So thank you to our chairman and vice chairman, not rule, but for our comments, because I really do believe that this is where the industry is heading. With that being said, I fully support using this RFI to either issue guidance or rulemaking in the near future. While I don't have questions, I would just say I agree that this is room for collaboration, not just with us operating in a vacuum at NCUA, but with our other peers. In fact, many of you may know that a lot of our other regulatory peers have already launched their fintech offices, or what they're calling their offices of innovation, whether it be at the CFTC, the SEC, the OCC, the FDIC, just to name a few. So I'm delighted that we will have an office that can work in collaboration with these other offices, because I do think there's a lot that we can glean insight from with each other. And more importantly, I think that this is a global issue. In fact, the past weekend, I was at a summit where we talked about fintech, and we were able to meet with regulators from the UK, from India. So, you all, this is an issue that not only calls for great collaborative efforts domestically, but I think internationally as well. So with that, I will conclude and look forward to the comments, everyone. Thank you, Mr. Chairman.
Thank you, Board Member Hood. And Vice Chairman Hoffman, is there a motion?
There is. I move that the board approve the request for information and comment on digital assets and related technologies for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
I second.
There is a sufficient second. All those in favor say aye.
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 All those opposed say nay. The ayes have it, and let the record show that the motion passed 3-0. The second and final item on our agenda today is a notice of proposed rulemaking, parts 702 and 703, complex credit union leverage ratio. Staff presenting are Tom Fay, Director, Division of Capital Markets, Office of Examination and Insurance; Rick Mayfield, Senior Capital Markets Specialist, Office of Examination and Insurance; and Rachel Ackman, Senior Staff Attorney, Office of General Counsel. Joining Tom, Rick, and Rachel to answer any questions after their presentation are Myra Tepe, Director, Office of Examination and Insurance; Vicki Narwald, Acting Associate Director, Office of Examination and Insurance; Allison Clark, Chief Accountant, Office of Examination and Insurance; and Catherine Metzger, Risk Officer, Office of Examination Insurance, as well as Ian Morena, Associate General Counsel, Office of General Counsel. You may begin when you are ready.
Good morning, Chairman Hopper, Vice Chairman Hoffman, and Board Member Hood. This is Tom Fay, and as you indicated, Chairman, I'm also co-presenting today with Rick Mayfield, Senior Capital Market Specialist, Office of Examination and Insurance, and Rachel Ackman, Senior Staff Attorney, Office of General Counsel. Today, we are here to present for the Board's approval a Notice of Proposed Rulemaking, or NPR. The first objective of the NPR is to provide a simplified measure of capital adequacy for federally insured natural person credit unions classified as complex. Under the proposed rule, a complex credit union that maintains a minimum net worth ratio and that meets other qualifying criteria will be eligible to opt into the complex credit union leverage ratio, or otherwise known as the CCULR. A complex credit union that opts into the CCULR framework would not be required to calculate a risk-based capital ratio under the final rule, which is effective January 1, 2022. A qualifying credit union that opts into the CCULR framework and maintains the minimum net worth ratio would be considered well capitalized. The second objective of this proposal is to make amendments to update the October 29, 2015 risk-based capital rule. It has been almost 6 years since the RBC rule was finalized. There have been developments in the industry and changes to other regulations during this time. Additionally, when the NCUA board delayed the implementation of RBC at its December 2019 meeting to January 1, 2022, it concluded that the extension would provide the necessary time to, one, holistically and comprehensively evaluate credit union capital standards for federally insured credit unions. Number two, determine how asset securitization would be considered for regulatory capital requirements. Number three, finalize the subordinated debt rule. Number four, consider the other banking agencies' CBLR analog and how it would be integrated into NCUA's capital standards. Number five, determine how the current expected credit loss, or CECL, methodology would be integrated into NCUA's capital standards. And lastly, number 6, provide additional time and resources toward the modernization of exam systems, updates for core report monetization, and the virtual examination program. This proposal, along with other companion rulemaking and initiatives, fulfill those board objectives. This NPR poses several questions designed to garner specific input into how stakeholders view the CCULR framework and the updates we propose to the RBC rule. The NPR also illustrates on what the CCULR and RBC call report forms may look like. In January 2021, the board issued an advance notice of proposed rulemaking, or an ANPR, addressing 2 approaches to simplify its risk-based capital, or RBC, requirement. We are proposing that the NPR, this proposal, be published in a Federal Register with a 60-day comment period. I will now turn the presentation over to Rachel Ackman, who will discuss the ANPR comments, the details of the CCULR, and the legal basis. Rick Mayfield will then cover the proposed RBC changes. Thank you.
Thanks, Tom. Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. As Tom said, at its January 14, 2021 meeting, the board issued an ANPR to solicit comments on 2 approaches to simplify its RBC requirements. The first alternative was the risk-based leverage ratio, or RBLR, which would replace the RBC requirements with a new capital framework. The RBLR would use relevant risk attribute thresholds to determine which complex federally insured credit unions would be required to hold additional capital buffers above the statutory leverage ratio. The second alternative is to retain the RBC requirements but enable eligible complex federally insured credit unions to opt into the CCULR. In general, commoners favored the NCUA developing a CCULR complement to RBC rather than adopting the RBLR as a replacement to RBC requirements. Many commoners were opposed to the RBLR because it would likely require higher capital requirements for federally insured credit unions holding certain assets compared to the current RBC requirements, the potential for a capital cliff, timing considerations, and it would negate work complex federally insured credit unions have undertaken to achieve compliance with the RBC requirements. In contrast, many commoners favored a CCULR framework because of its similarity to the capital framework of the other banking agencies and because it's a more flexible framework as federally insured credit unions have the option of calculating the more complex RBC for a more precise and generally lower overall capital requirements. Before I get into the details of the proposed rule, I'll briefly discuss the statutory authority for the rule. The Federal Credit Union Act, or FCUA, requires the board to adopt a system of PCA for credit unions that's consistent with the FCUA and comparable to Section 38 of the FDI Act. The FCUA requires that the NCUA system of PCA includes, in addition to the statutorily defined net worth ratio requirement, a risk-based net worth requirement for credit unions that are complex, as defined by the board. The Federal Credit Union Act grants the NCUA broad authority to design the risk-based net worth requirement. The Federal Credit Union Act does not define the term risk-based net worth and only sets forth general guidelines for the design of the requirement. Specifically, the statute requires that the board design the risk-based net worth requirement to take account of any material risk against which the net worth ratio required for an insured credit union to be adequately capitalized may not provide adequate protection. The risk-based requirement needs to account for risk in some manner, but does not set forth a specific manner of doing so. The CCULR would account for risk through both the higher net worth requirement and the eligibility criteria. In addition, the 2015 RBC final rule would also remain in place to address relevant risks for complex credit unions that do not or are not eligible to opt into the CCULR. As Tom said, this proposed rule would primarily provide a simple measure of capital adequacy. Under the proposed rule, a qualifying complex credit union that meets the minimum CCULR, which is equal to its net worth ratio, would be eligible to opt into the CCULR framework. The rule would relieve complex credit unions that meet specified qualifying criteria and have opted into the CCULR framework from having to calculate an RBC ratio as implemented by the final RBC rule. In exchange, the qualifying complex credit union would be required to maintain a higher net worth ratio than is otherwise required for the well-capitalized classification, namely 7% of total assets. If the credit union maintains the minimum net worth ratio set by the CCULR, it would be considered well-capitalized. Under the proposal, the qualifying complex credit union would be defined as a complex credit union meets the following criteria: has a CCULR net worth of 10% or greater, subject to an initial transition period. A credit union would need a CCULR of 9% or greater when the rule becomes effective in January of 2022. Has total off-balance sheet exposures of 25% or less of its total assets. Has the sum of total trading assets and total trading liabilities of 5% or less of its total assets. And has the sum of total goodwill, including goodwill that meets the definition of excluded goodwill, and total other intangible assets, including intangible assets that meet the definition of excluded other intangible assets of 2% or less of its total assets. Details of what constitute the off-balance sheet exposures and trading assets and liabilities are in the proposal. Complex credit unions that do not meet any one of the qualifying criteria would be subject to the RBC requirements to ensure that such credit unions hold capital commensurate with the risk profile of their assets and off-balance sheet activities. Under the other banking agencies BBLR framework, only depository institutions or depository institution holding companies with total consolidated assets of less than $10 billion are eligible to use the CBLR. The proposal for the CCULR would apply to all complex credit unions with assets over $500 million. We believe that the CCULR framework appropriately captures the risk for all complex credit unions, regardless of asset size, because the Federal Credit Union Act limits the types of assets a federal credit union can hold compared to banking organizations. Under the proposal, the CCULR would be the net worth ratio. The proposed rule uses the net worth ratio for its simplicity. Any amendments to the definition of the net worth ratio would also be applicable to the calculation of the CCULR. For example, the board finalized changes to the net worth ratio to provide that, for purposes of the PCA regulations, credit unions may phase in the day one impact of transitioning to the CECL methodology. This change would be part of a credit union's net worth ratio and therefore its CCULR. Subordinated debt, however, would not be eligible for inclusion as capital under the CCULR framework unless the complex credit union is also a low-income designated credit union as required by the Federal Credit Union Act for inclusion in net worth. Under the proposal, a qualifying complex credit union may opt into the CCULR framework if it meets the minimum CCULR at any time of opting into the framework. Initially, the minimum CCULR would be 9%. The proposed rule phases in the 10% requirement due to the unprecedented and significant balance sheet growth that has occurred at complex credit unions since the start of the COVID-19 pandemic. To help mitigate the impact of this unprecedented balance sheet growth, the proposed rule includes a 2-year transition provision. On January 1st, 2023, a complex credit union that has opted into the CCULR framework must have a CCULR of 9.5% or greater. After January 1st, 2024, a complex credit union that has opted into the CCULR framework must have a CCULR of 10% or greater. When considering the appropriate calibration to the proposed CCULR, the rule seeks to strike a balance between strong capital levels and providing appropriate regulatory burden relief. The proposed rule also is intended to be comparable to the other banking agency's CBLR framework, which established a CBLR of 9%. The authorizing statute for the CBLR required that the CBLR be not less than 8% and not more than 10%, which is 300 to 500 basis points higher than the 5% leverage ratio required for well-capitalized status under the other banking agency's PCA framework. Insured banks and credit unions, however, have different minimum requirements under their PCA framework. A similar 300 to 500 basis point range would equate to a CCOR of 10 to 12% for credit unions. However, one of the underlying reasons for the higher statutory net worth requirement may no longer be as relevant given changes in the credit union industry. Congress partly established a capital level 2 percentage points higher than the other banking agencies' leverage ratio because 1% of a typical credit union's capital was dedicated to its corporate credit union. That is no longer true. Due to the reduction of concentration in corporate credit union capital, we considered a potential ratio for the CCOR of 9 to 11%. The proposed rule includes the CCOR of 10% to ensure strong capital levels and more certainty that qualifying complex credit unions are holding greater levels of capital than under the 2015 final RBC rule. If all eligible credit unions opt into the CCOR and hold the minimum 10% net worth required to be well capitalized, the total minimum net worth required would increase capital required by $24 billion as compared to the final RBC rule. A qualifying complex credit union may opt into the CCOR framework into each calendar quarter. A complex credit union that has opted into the CCOR framework may opt out any calendar quarter end. A credit union opting out of the CCOR framework must provide notice to the NCUA that includes a statement of the reasons for opting out, a copy of board meeting minutes showing that the credit union's board of directors was notified of the election, when the opt-out election is planned, and a completed call report schedule as if the complex credit union had calculated its risk-based capital ratio from the prior quarter. The proposed rule includes a notice requirement because it's likely that a credit union opting out would not have any experience calculating an RBC ratio. If after a credit union has opted into the CCOR framework, it no longer meets one of the eligibility criteria, then it would be required within a limited grace period of 2 calendar quarters, either to once again meet the qualifying criteria or to comply with the RBC ratio requirements. During the grace period, the credit union continues to be treated as a qualifying complex credit union and must continue calculating and reporting its CCOR unless it has opted out of using the CCOR framework. Additionally, during the grace period, the qualifying complex credit union continues to be considered to have met the capital ratio requirements for the well-capitalized capital category. However, if the qualifying complex credit union has a CCOR of less than 7%, it would not be considered well-capitalized. Instead, its capital classification would be determined by its net worth ratio. If it is likely that the credit union will be required to calculate risk-based capital at the end of the grace period, then the proposed rule would require the credit union to provide notice to the NCUA, similar to a credit union electing to opt out of the CCOR framework. Next, I will hand the presentation over to Rick to discuss proposed RBC changes.
Thanks, Rachel. Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. As Tom mentioned, we are proposing amendments to the 2015 RBC final rule. I will give an overview of these amendments. There are 4 areas with proposed changes to the risk-based capital denominator. I will briefly discuss these changes. First, the proposal is excluding unconditionally cancelable unfunded commitments from the risk-based capital denominator. This proposed change will make NCUA's RBC more comparable to other banking agencies' rules and provide significant burden reduction for complex credit unions calculating risk-based capital. This change will likely lower the risk-based capital denominator for many complex credit unions. The proposal also clarifies the specific exposure amounts, credit conversion factors, and risk weights for other off-balance sheet exposures. Many of these changes are not new, but are a clarification for these off-balance sheet exposures and their capital treatment. The proposed off-balance sheet amendments collectively support the definition for CCULR eligibility and are consistent with the other banking agencies' CBLR framework and general capital rule. Secondly, the proposal is addressing risk weights for asset securitizations issued by complex credit union. To date, we are aware of 2 credit unions that have issued asset securitizations, and addressing asset securitizations in risk-based capital was one of the reasons RBC was delayed in 2019. For asset securitizations, the proposal is assigning a risk weight of 1,250% for non-security beneficial interest of an asset securitization. A credit union will have the option to weight a retained security beneficial interest of a securitization at either 1,250% or use the gross-up approach in the current rule. The third proposed change for risk-based capital denominator is the risk weights for supranational organizations and multilateral development banks. The current rule does not have specific risk weight for these investments, and therefore they would default to a 100% risk weight. The proposal assigns a risk weight of 0% to these investments, consistent with the other banking agencies. World Bank debt is an example of an investment that would fit into this proposed change. The last change to the risk-based capital denominator is for Paycheck Protection Program loans. The proposal assigns a risk weight of 0% to these loans, consistent with the requirements of the CARES Act. The proposal has one change to the RBC numerator. The proposal would deduct the balance of mortgage service assets that exceed 25% of the RBC numerator from the RBC numerator. Mortgage servicing assets are also commonly known as MSAs or MSRs. This change is consistent with other banking agencies' RBC approach that was simplified post-issuance of the 2015 final RBC rule. This change is to address any potential excessive MSA exposures at complex credit unions. Currently, there are no complex credit unions that exceed the 25% threshold. There are also several proposed changes to definitions in the proposal. Definitions were changed to address the proposed changes I just discussed. Furthermore, definitions were updated to align to the recently finalized derivatives rule. There's also an update to the definition of consumer loan to clarify that the consumer loan category includes consumer leases, in addition to other minor technical corrections to some definitions. Before I finish, I would like to point out again that we are including illustrations the CCULR and the RBC call report forms in the preamble. We want the industry to have an idea of what the forms look like, and that the NCUA intends to separately seek comment on the proposed call report changes. We plan on auto-populating RBC and CCULR call report fields when possible. We are also planning on providing sufficient instructions for credit unions to properly fill out forms consistent with the final RBC rule. Thank you, and this concludes our prepared remarks. We are happy to answer any questions.
Thank you so much, Tom, Rachel, and Rick, for your informative presentation, as well as your diligent efforts in bringing before the NCUA board today the complex credit union leverage ratio, also known as CCULR, as all of you pointed out, but as somebody who had a speech impediment growing up, I will refer to as COOLR, as well as amendments to the agency's 2015 risk-based capital rule. When testifying at my confirmation hearing a little over 2 years ago, I said that capital and liquidity would be a priority for my work on the NCUA board. Therefore, I am pleased that we are considering the COOLR rulemaking today. I have long held that financial institutions backed by federal deposit insurance, including federally insured credit unions, should hold capital equal to the risks held on their balance sheets. In the case of federally insured credit unions, if a credit union with greater risk fails, risk-based capital would help to minimize the losses to the National Credit Union Share Insurance Fund. Capital, after all, is the first line of defense against losses. In the event of a complex credit union failure, the additional capital buffer provided through robust risk-based capital framework protects surviving credit unions, their members, and the taxpayers who ultimately guarantee the Share Insurance Fund. When it comes to risk-based capital standards for credit unions, we have 3 legal responsibilities on the NCUA board, which can be summed up in 4 words: comparable, consistent, complex, and cooperative. First, these standards need to be comparable to the rules developed by other federal banking agencies and consistent with the requirements of the Federal Credit Union Act. Second, whereas risk-based capital rules apply to banks regardless of their size, in our rules, we need only to apply them to complex credit unions, which the board has currently set at $500 million in assets. And third, our risk-based capital rules must address the cooperative nature of the institutions that the NCUA regulates, which traditionally have built capital only with retained earnings. In my view, the risk-based capital rule improved in 2015 met all of those standards, and once implemented, it will provide the system with greater stability. We must, however, also recognize several legislative, regulatory, and marketplace developments since the NCUA board approved the risk-based capital rule in 2015. For example, in 2018, Section 201 of the Economic Growth, Regulatory Relief, and Consumer Protection Act directed the other federal banking agencies to propose a simplified alternative measure of capital adequacy for certain federally insured banks. The result of that effort became known as the Community Bank Leverage Ratio Framework, which became effective at the start of 2020. Since 2015, the NCUA has also approved several regulatory measures, like our new final rules on subordinated debt and derivatives, which affect a credit union's capital levels. Additionally, credit unions have begun issuing their own securitizations to investors. We need to take those developments into consideration when acting today. Accordingly, the proposed rule incorporates all of these items and addresses stakeholder comments gained as part of the earlier advance notice of proposed rulemaking approved in January. Primarily, this proposed rule would amend the NCUA's capital adequacy regulation to provide a simplified measure of capital adequacy for federally insured credit unions classified as complex. The proposed complex credit union leverage ratio for federally insured credit unions is comparable to the community bank leverage ratio. In essence, both standards seek to strike a balance among several objectives, including maintaining strong capital levels, protecting safety and soundness, and simplifying compliance. As long as an eligible credit union in the Cooler framework maintains a minimum net worth ratio, it would be considered well capitalized. The initial minimum net worth level set under the Cooler framework would be 9% on January 1st, 2022, and this level would gradually increase to 10% by January 1st, 2024. Using year-end 2020 financial performance data, the NCUA estimates that nearly 3/4 of complex credit unions would initially be able to meet the Cooler's net worth requirement of 9%. In lowering a credit union's risk-based capital compliance requirements, Cooler increases the system's capital buffer. Under the 2015 final rule, the total minimum capital for complex credit unions to be considered well capitalized is estimated to be $82 billion. Under the proposed Cooler framework, if all qualifying credit unions opt to use the minimum 9% level during 2022, the total minimum net worth estimated is to be $104.6 billion, an increased capital requirement of $22 billion. This additional capital would strengthen the system's ability to absorb future financial losses and economic shocks. The proposed rule makes clear several other changes to the NCUA's risk-based capital rule, including clarifying the treatment of off-balance sheet exposures and deducting certain mortgage servicing assets included in a complex credit union's risk-based capital numerator. The proposed rule also clarifies the risk weights for asset securitization, which were not included in the 2015 rule because credit unions had not yet begun to engage in this activity. While we have seen some positive signs that the economy and in credit, seen some positive signs in economic and in credit union performance data, we are not out of the woods yet when it comes to the COVID-19 pandemic's economic effects. With supplemental unemployment insurance programs expiring, foreclosure prevention efforts ending, and eviction moratoriums coming to an end, many households could face financial stress in the coming months. If so, then we could see higher delinquency and charge-off rates and potential losses for credit unions and even failures in the coming months. An uncertain interest rate environment and the potential for continued elevated insured shares also place additional stress on credit union capital levels. As such, this proposal is an appropriate measure that provides complex credit unions with a streamlined approach to managing their capital levels while also strengthening the system's resiliency to economic shocks. Before I recognize the other board members, I do have one question for staff. Under the proposed rule, the NCUA is taking a similar approach to the risk weights for asset securitization as the federal banking agencies. Would you explain why this approach makes sense?
Yes, Chairman Harper, this is Rick Mayfield, and I'll be taking this question. Yes, we are using a similar but not identical approach for asset securitizations as the other federal banking agencies. For this proposed rule, NCUA needs to address a credit union's retained interest in asset securitizations credit unions may issue. Retained interest in asset securitizations are typically in the form of subordinated securities or non-security beneficial retained interests. For subordinated securities, a credit union will be able to use the gross-up approach or apply a 1,250% risk weight for the exposures. The gross-up approach uses the risk weight of the underlying asset in the securitization and multiplies it by the amount of leverage the subordinated tranche creates in relationship to the more senior tranches. The credit union may apply a 1,250% risk weight to avoid this calculation, or if the calculation results in a risk weight of over 1,250%. We believe this approach makes sense since it takes both the risk of the underlying assets and the leverage of the assets into consideration when applying a risk weight. For non-security beneficial interests, NCUA took a simpler approach than the federal banking agencies. For non-security beneficial interests, NCUA is proposing to apply a 1,250% risk weight to the exposures. We believe this makes sense since these are typically the most subordinated portions of an asset securitization and the burden is minimal to a credit union. This concludes my answer.
I think you're on mute, Todd.
The hazards of operating in a virtual environment. Rick, thank you again for that clarification, and thank you to everyone for all of your diligent efforts in getting this proposal across the finish line. In sum, this proposed rule is a balanced approach that gives complex credit unions a risk-based capital framework comparable to those developed by the other federal banking agencies. It strengthens the system's capital levels and provides complex credit unions with a streamlined approach to managing their capital. As we continue to address the fallout of the COVID-19 pandemic, this proposal is a prudent course of action. That concludes my remarks. I now recognize Vice Chairman Hoffman. Hopefully you will not be on mute like I was.
No, thank you, Mr. Chairman. No, there's no two ways about it. The last 18 months, the #1 phrase in America is, hey, you're on mute. Before I start, regarding the blockchain and crypto RFI we discussed earlier, it looks like we're going to go live for comment sometime next week after it's officially in the Federal Register, so 60 days from now. I mention this because blockchain is a fairly new industry, and we're hoping to get comments from entrepreneurs and others who may not be used to dealing with government agencies and the RFI process. So back to the issue at hand.
Vice Chairman Hoffman, if I may, for just a second,
yeah,
I think
please.
We should do, Because those entities are not familiar with our website and where to find this information, we should ask staff to put a button on the front page of our website to help direct them there if you agree.
100%. And our social media, Twitter, hey, it's live, go here. Again, if we do this right, we're going to reach people who are not used to agency RFIs, you know.
Yep.
So I appreciate that. Thank you. Regarding the leverage ratio, I'm also going to call it cooler, like the chairman does. And Mr. Harper, I'm sure you remember, you know, you and I both worked on Capitol Hill, and one of our jobs was trying to create names for legislation that had a cool acronym, you know. And that was one of the little minor talents that we tried to cultivate.
Yes, indeed.
About the cooler, yes. Thanks to the staff, all your work on this. This has been quite an effort. I want to say that the chief benefit of the proposed cooler is that it allows some credit unions to bypass a risk-based capital approach. For me, the point of this simpler leverage ratio is that it protects both credit unions and the Share Insurance Fund from the inevitable problems associated with risk weighting. As I said in my nomination hearing, capital is the holy grail. When a recession hits, the first thing I'd want to know about any deposit-taking institution is how much total capital they have. However, the problem arrives with implementing risk-based capital, even though we all agree that some assets are riskier than others. In fact, the exact same asset can be riskier in the hands of one credit union versus being held by a different credit union, partly due to differences in loan servicing, for example. It seems to me the historical problems with risk ratings stem from two factors. Number one, humans make risk ratings, and humans are imperfect, especially when it comes to using the past to predict the future. The second problem is about which humans are setting the risk ratings. They are set by political appointees with the best of intentions, while credit unions assess risk every day. The official risk rates are set in a process that is, by definition, a political process and removed from the day-to-day reality in which credit unions operate. Ask anyone who has been to the meetings in Basel, Switzerland. Basel is a small city that's known for two things. It's Roger Federer's hometown, and it's where governments gather to talk about risk ratings. The various political appointees often advocate for things that benefit their home constituencies. To pick just one example, European governments wanted low risk ratings on, you guessed it, European government bonds. And then during the European debt crisis, those same risk ratings wound up increasing risk. The market shifted rapidly, but of course the risk ratings did not. Greek bonds fell to junk status. Greece needed an IMF rescue. They took 4 years out of the debt markets. Meanwhile, supposedly more risky assets perform much better. To be clear, I'm making a comment about the risk weighting process, not critiquing the individuals involved, who probably did the best they could at the time. And for anyone who's fortunate enough to not be aware of the Basel risk weighting process, here's another example from outside finance. Decades ago, governments around the world wanted to reduce the risk of fatalities caused by fires. So they promoted the use of asbestos. And they were right. Asbestos is useful at preventing fires. But as we know, it created new problems such as thousands of deaths from cancer. Those same governments, often without the slightest bit of contrition or self-awareness, then chastise people to remove the asbestos, and they chastise people who had followed their government's lead in installing it. I know it's not a perfect analogy, and obviously we need building safety standards. Just look at the recent condo collapse in Miami. My point is merely an obvious one, that governments aren't perfect, and wherever possible, we should find solutions that don't rely on waiting for political appointees to make nearly impossible judgment calls. So all of that is an admittedly long way of saying that a simpler yet higher capital standard isn't just useful because it saves time and effort. It's a way of protecting the system from the problems inherent in any risk weighting process. In conclusion, we can argue about exactly how much capital is appropriate to switch to a simpler capital ratio, and I'm aware that is not a small conversation. But so long as we must prepare for the possibility of a world with risk-based capital, I encourage everyone to submit comments on today's proposals, including the issue of how to treat the 1% of credit union assets that sits in the Share Insurance Fund. That concludes my remarks, and I have a couple questions. Anybody can take this one. I just want to get this clear. To review, we are asking for comment on minimum net worth levels of 8%, 9%, or 10%. Is that correct?
This is Vicki Narwhal. I'll take that. Yes, sir, that is correct. We did include a question in the NPR specifically requesting comment on a CCULR threshold of 8, 9, or 10%. And that concludes. Thank you.
Terrific. Thank you. And you guys could take this one either way. If Cooler had been around the last, say, 20 years, what would have been the benefits to NCUA and the credit unions? And I also want to ask, what would be the benefits in the coming decades?
So this is Rick Mayfield. I'll take this question. So in the past 20 years, a Cooler framework would have really only benefited if we had a risk-based capital type framework. So I'm not sure there would have been a benefit versus risk-based net worth.
That's why the future is probably a better way to do this. Yeah.
The future is actually a better question, and we are talking about the complex credit union, so this wouldn't be the entire universe. But the real benefit of the Cooler is complex credit unions would have a simplified way to meet their risk-based net worth requirement mandated by the Federal Credit Union Act. So less burden for them. On the other hand, for the NCUA, or better said, the Share Insurance Fund, the Share Insurance Fund would be benefited from complex credit unions generally having a higher minimum level of required capital available to protect against losses. Credit union net worth is the first line of defense before the Share Insurance Fund. We believe the Cooler option is a win-win for the credit union industry and NCUA and the Share Insurance Fund. This concludes my answer.
That is a very solid summary of the benefits. And as my last question, I'll ask it to Myra partly because it's question's a little bit flip, but looking at the last 18 months or last 18 years, are we humans or government officials infallible about predicting the future?
This is Rick Mayfield. I'll take that question.
Sure,
we are not.
That's fine.
We are not. There's no doubt.
Yeah, we are not. We are not.
We don't have a crystal ball, and there's no perfection as far as us determining the future.
We get caught flat-footed often, and I think maybe human nature, we're often particularly bad at predicting sudden, very terrible events in the future. When the First World War ended, we didn't name it World War I. That would have been incredibly pessimistic, but it would have been correct. So anyway, I just want to say I'm certainly not good at predicting the future, nor are most of us. If we were 15 years ago, probably would have had different risk weightings assigned to taxi medallions. One of us on this call probably would have invented Uber, and we'd be sitting here today as a billionaire waiting to go on a private space flight. That concludes my remarks. Back to you, Mr. Chairman.
Thank you so much, Vice Chairman Hoffman. And there's actually a third reason that Basel is known around the world, and it's a small little company called Nestle Chocolate, has offices in Basel. So, Board Member Hood, you're welcome to make your statement now.
Great, thank you, Mr. Chairman. And I'd also like to thank Tom, Rick, and Rachel. And I'd also like to get back to the days when basil was just an herb. I certainly agree with my fellow board members when it comes to the importance of capital and liquidity. In fact, with many of my recent congressional testimonies when I was chair, I would often talk about how capital and liquidity are the bedrock and the foundation upon which the safety and soundness of the credit union system rest. I also, though, recognize that our core mission as an agency is to maintain a safe and sound credit union system and be good stewards of the National Credit Union Share Insurance Fund. Moreover, the Federal Credit Union Act requires the NCUA to maintain a system of prompt corrective action for federally insured credit unions that is based on an institution's level of capital, that is, its net worth. The Act requires us to maintain a risk-based net worth requirement for those institutions we deem to be complex credit unions. These are serious responsibilities which we must faithfully uphold, and quite frankly, I would be derelict and feckless in my responsibilities if I did not do so. In 2019, as then chairman, I worked with the NCUA board to delay the risk-based capital rule for 2 years to holistically evaluate the NCUA's capital standards to ensure they would serve us well in the future. This also was an opportunity to further study the impact of the risk-based capital rule. During that time, staff said there were 3 main additional considerations that were warranted: subordinated debt, the credit union leverage ratio, which we're now calling CULR, and securitization. While work remains to be done with securitization, we made profound progress in terms of the agency's view of capital compared to where we were 2 years ago. However, Mr. Chairman, I must say that after serious study and consideration, my preference would be to table the risk-based capital rule indefinitely, or actually even consider repealing it. And therefore, I would like to actually focus on a risk-based net worth rule as needed. Let's all take a trip down memory lane. This is a rule that was passed in 2015, and it would be 8 years old by the time it goes into effect. Not exactly as fine-tuned as many of us would like. The world has changed considerably since 2015. The reality is RBC should be a tool and not a rule. It is effective in identifying risk, put it in the examiner's toolbox, but the last thing I think the NCUA should do is impose it on credit unions as an operating model. The juice just isn't worth the squeeze for risk-based capital because this is a regulatory burden with limited benefit. Again, we already have a risk-based net worth framework as required by law, so this is not needed. I do have a few questions, though, and anyone can ask these. How do we go about defining risk?
This is Vicki Narwhal. I'll take that question. So the NCUA has defined risk as the potential that events, expected or unexpected, may have an adverse effect. And that concludes my response, sir.
Well, thank you, Vicki. But then I would go on to say then that's almost as if we're predicting the weather. There are so many interrelated variables that I must say that no algorithm or evaluation model has ever been able to really succeed in accomplishing this. If that were the case, Wall Street would have done this a long time ago. Another question is, when the RBC rule was finalized in 2015, the vast majority of individual commenters opposed the rule at that time. Is that correct? Since many of us on the board today were not here then, was that correct? And could someone really let me know what some of the commenters had to say?
Board Member Hood, this is Rachel Ackman. I'll be taking this question. Yes, a majority of the significant comment letters, received stated that the commenter opposed the proposal in its entirety, and many of these commenters said they suggested that the rule be withdrawn. We also received hundreds of other non-substantive comments that were also opposed to the rule. And this concludes my answer.
And I didn't want to cut you off, but it sounded like there may have been a sneeze there. If that were the case, bless you. Did not want to startle you in the middle of your presentation. Thank you. Could someone please, oh, you're fine. Could someone please tell me what we've learned about risk since the RBC model was finalized?
Board Member Hood, this is Rick Mayfield. I'll take this question. I would say the biggest thing we learned about risk is that we don't always know where it will come from. I think COVID is a perfect example. And I also think COVID will make many others think beyond financial risk in the future. This concludes my answer.
Great, thank you. And in fact, I would say that there is a Federal Reserve governor that agrees with your assessment. I heard a recent speech where the comment was made about the importance of capital, but how there's not enough capital in the world that could ever prepare for a huge cybersecurity breach or a data protection breach. So I hear you there. What do we know about risk, though, that is different from earlier crises or crises? Said another way, how does a public health risk like a COVID-19 pandemic affect financial services? Before COVID, I guess the previous crisis was the financial crisis that we all lived through over a decade ago.
So, Board Member Hood, this is Rick Mayfield again. I'll take this question too. As we've seen with COVID, a pandemic can have a material effect on financial services, including access to financial services. The previous crises, and I'm referring to the Great Recession, created large credit losses and in many cases a liquidity crisis. Oftentimes the credit losses manifested into the liquidity crisis. In the COVID crisis, we generally haven't seen any material increases in credit losses, and the current problem with liquidity is that we have too much liquidity. The effects on the financial services by COVID are not yet fully known since it's not over, but the risk to the financial system appear to be far less than the Great Recession. This concludes my answer.
Rick, thank you. If I could then move over then, or just move on, if then COVID-19 could carry over and affect the financial services sector, what does that pretend or suggest about other external crises?
Board Member Hood, I'll continue with this. So external crises do have the potential to have an effect on the financial system. This effect could be more localized. It could be national. Credit unions and other firms in the financial sector should take the effects of external crises into considerations when managing risks on their balance sheet. And this is whether or not they are, for example, climate or politically related. This concludes my answer.
Thank you. Continuing with my questions, are the primary risks then to a credit union's financial sustainability internal or external?
And Board Member Hood, I will take this again. So this can be debated that it's both, but I would actually argue that the risk starts internally. A credit union has the ability to manage risk internally to help immunize against external risks, and not doing so is an internal risk. For example, a credit union could increase net worth to better protect itself from credit events. A credit union could avoid concentrations, which by loan or investment type. External risk can create issues for a credit union, but proper internal risk management can help manage those external risks. This concludes my answer.
So then, Rick, it sounds then as if we're saying that they're both internal and external. And if that's the case from the internal perspective, how do we go about explaining the fact that many credit unions, all of whom exceed the 7% well-capitalized level, and quite many more instances even much higher, seem to be losing members and loans, and still they meet our criteria for safe and sound? What is missing in the RBC model for these credit unions for their internal risk then?
Could you repeat that question, Board Member Hood?
Yes,
this is Myra.
Yes, if we're looking at internal risk, for instance, how do we explain the fact that many credit unions, all of whom exceed the 7% well-capitalized level, and many of them even have higher levels, they seem to be losing members and loans, and yet they can still meet our criteria for safe and sound? What is missing in the RBC model for these credit unions for internal risk?
Well, for some of them, they may not be missing anything because they actually may have a regular net worth ratio that's fine. They actually may have great portfolio diversification already. So I'm not thinking that some of them are actually missing anything. It's just that some of them may have certain portfolio diversification standards that might have a certain type of loan in their portfolio or an off-balance sheet risk that might subject them to a type of risk that they might want to hold more capital for. So it really would depend on a credit union specific issue, and whether they're losing members or loans. I'd have to actually look at the credit union on a specific example. That concludes my response, sir.
Great, thank you, Myra. And that certainly does help with the internal piece. But then for external risk, how are these external risks then or captured in the RBC model? Where, in fact, would cyber risk be in the model?
Mr. Hood, hi, this is Tom Fay. I'll take that question. Of course, not every risk can be exhibited or at least demonstrated through a risk-based capital model. Risk-based capital model, at the end of the day, is probably another tool for NCUA to use to dimension risk across the agency. So in other words, we might identify certain asset types and certain concentrations in those balance sheets that would help us dimension and at least to identify outliers. There's the non-financial, as you mentioned with cyber, it would not. This is just one tool for NCUA's examination cycle. That concludes my answer.
Great, thank you. But I still just must say, I think risk is something that you manage every day. It's really not a formula I think that you can run on your balance sheet. In fact, I mentioned one of the other Federal Reserve governors talking about not enough capital in the world preparing for a huge cybersecurity instance. I would also like to just quote the former FDIC chairman, Thomas Honig, who said that, and I quote, "Regulators are no better than anyone else in predicting emerging risk," end quote. And I have to tell you, I actually concur with him. But moving on, I do just have a quick few more questions. How would you move on and say that risk is uncertain? Is risk uncertain?
This is Vicki Narwhal, Board Member Hood. I would say that risk may result from events that are certain or uncertain, and that concludes my response.
Well, thank you. But I would just go on to say I believe that many macro risks are uncertain and we simply cannot be clairvoyants. So while RBC may require higher net worth ratios at certain so-called complex credit unions over 500 million based on how we risk weigh their activities, we cannot assume that RBC will prevent a credit union failure, and we can't assume, since risk itself evolves, that the risk weights are fixed and set for all of time. If anything, RBC creates a moral hazard because we as regulators are weighting risk. We're giving a stamp of approval on the weights of risk, but we should recognize that since risk evolves, it's not stagnant. And as we're often reminded, the future, and especially future crises, aren't predicted with a great deal of precision or accuracy. Risk, like a global pandemic, are impossible to put in a formula. Who, in fact, sitting on the board call today was talking about the risk of a pandemic when we did our January 2020 board meeting. So I think we could all see a critical lesson we should take from the events of last year is that humility is vital to surviving and thriving in today's world. It is important to admit that our knowledge and perspective are indeed limited, and that we usually do not predict the future with any modicum of clarity. And by that standard, 2020 was a profoundly humbling year for many of us. Shifting gears, I know the taxi medallion piece was mentioned earlier during this Q&A. Would any of the taxi credit unions that failed be subject to RBC based on the change a few years ago that moved the RBC threshold of complex credit unions from $100 million to $500 million?
Thank you. This is Catherine Metzger, and I'll take this question. As you noted, in 2018, the supplemental rule for risk-based capital increased that complexity threshold to $500 in total assets. With a higher threshold in place, had the 2015 rule been in place back in 2015, 2 of the 6 primary taxi medallion credit unions would have been bound by the risk-based capital standard. This concludes my response.
Great. And if I may, I do have a follow-up. So then in light of the failures of the credit unions because of the taxi cab medallion crisis, would their risk weighting be any different based on any changes, including proposed board changes made to the RBC rule?
This again is Catherine. Hopefully I can address that. The risk weightings would not have changed necessarily in October 2015 when the RBC rule was initially finalized. The credit unions primarily impacted by the decline in the taxi medallion values were recognized as supervisory concerns based on our supervision program. However, the taxi loans within their portfolios were risk-weighted under RBC in the same manner as a commercial loan, with the risk weights in 2015 and currently ranging from 100% to 150%, depending on the concentration of commercial loans. For commercial loans less than 50% of assets, the risk weighting was 100%, but for commercial loans in excess of 150% of assets, the risk, let me restate that, but for the commercial loans in excess of 50% of assets, the risk weighting applied is 150%. It's also important to be mindful that the non-current commercial loans would have also received that 150% risk weighting. So by and large, most of the portfolios would have received the higher risk weighting. I hope that answers your question. That concludes my remarks.
It does, and thank you for catching a moment there to clarify. I think you were seeing that some of the board members were looking a bit flummoxed, so thank you for that response. For the tax medallion losses, those credit risks were exacerbated, I think, because of the new market entrant, ride-sharing services, among other factors that actually inflated the value of the underlying asset of the taxi medallion. Markets, as we all know, evolve with competition, and so does risk. It certainly is important for any agency to be forward-thinking, and as we've learned during the taxi medallion crisis and most recently the pandemic, and it bears repeating, the future is so hard to predict. I would say that while credit risk is important, which is what RBC is designed to manage, it actually does a poor job of doing so, especially for macro events. Risk will never be captured by a formula to manage a balance sheet. And in my concluding couple of questions, I just want to get a feel for what the budget will be for the RBC piece. And that is, I've seen various estimates of it going as high as $2.2 million to implement. And I just wanted to know if someone could really speak to what it would cost to implement this $2 million. Is it $2 million or over based on the 2015 vote of RBC? Could someone speak to that? Would this represent new proposed headcount, more exam hours? Could someone really walk me through that, please?
All right. This is Myra Tepe, Director of the Office of Examination Insurance. RBC, not Cooler. The 2015 BAM actually discussed the cost of the RBC rule, and it was estimated to be just over $2 million. So it was actually in the BAM in 2015. And that was basically labor costs for implementing changes in the call report and systems. And then in the 2019 BAM, when I believe when it was the approval to extend, it actually talked about that much of the development work had been extended. There was, and then there's no additional FTEs. I mean, those are basically the labor charges that were an external cost of labor to extend, actually to pay for RBC. So that concludes my response. There's no actually anticipated increase in E&I staff, if that's what you're asking for.
Yes, thank you, Myra. That was what I was wanting to get a feel for.
Okay.
And then one other question, and that's about the risk rating for a subordinated tranche. Could someone please speak to what the risk rating would be, and then maybe if there is a practical example?
Board Member Hood, this is me. So this is Rick Mayfield, and I'll answer that question. So for subordinated tranche, the risk weighting is one of two things, and this is for a security that's a subordinated tranche. It's either 1,250% or it's using the gross up methodology. So for example, if the collateral, the subordinated tranche, let's say represents $2, and the amount of senior tranches that it supports is $8, then that would have 5 times leverage. So one would have to find the risk weighting of the underlying assets, and let's say it's a 50% risk-weighted mortgage, and you multiply the 50% times the 5 times leverage that subordinated tranche is supporting, and that would come out to be a 250% risk weighting. So the credit unions do have ability to have a lower risk weighting than the 1,250 that we let them default to at their option if they go through this calculation. So the higher the risk weighting of the underlying assets and or the higher the leverage, that would equate to a higher risk weighting, all else equal. We did have examples in the final RBC rule, and we'd be happy to walk credit unions through that calculation if they would need it, if they have subordinated tranches. That concludes my answer.
Great. Well, thank you. And again, I know I've asked a number of questions, but I want you to know I certainly do appreciate all of your hard work. Many of you have been working on all of these issues for quite some time, so do know it's greatly appreciated. In closing, while I do not support the risk-based capital rule at this time, I'm also mindful that it is July 2021, and this date is relevant because the RBC rule goes into effect in January 2022 as it stands now. The proposed rule today does provide an off-ramp to RBC with the credit union leverage ratio, cooler, which is indeed a small step, I think, in the right direction. So because of these factors, Mr. Chairman, I will begrudgingly vote for today's proposal. Thank you.
Thank you very much, Board Member Hood. I believe Vice Chairman Haltman, you have a motion?
You're muted.
Yeah.
All right. I've had problems being off mute, and I've had problems being muted. Yes, I have a motion. I move that the board approve the notice of proposed rulemaking, Part 702 and 703 of NCUA's rules and regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye.
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 Aye. All those opposed say nay. The ayes have it, and let the record show that the motion is passed 3-0. That is the end of our agenda today, but I do want to take a lead from Vice Chairman Haltman, and others may want to have a few words here. I want to thank all of the staff at the agency who worked on the most recent new charter that was issued by the agency for Community First Fund Credit Union up in Pennsylvania. It's really always a piece of good news when we get a strong new credit union out the door, and it's a lot of staff effort in both our Office of Credit Union Resources and Expansion, as well as at the regional effort. So I do want to take the time to thank staff. I don't know if you would like to say a few words, Vice Chairman Haltman.
Yeah, well, I appreciate you bringing it up. Again, that was one of my, de novo was one of my 3 priorities, but again, I realize I'm not the only person in the world who thinks about this. It is great to see it. We lose a couple hundred credit unions a year, and it's not NCUA's job to say how many there should be, but it is our job to make sure that if someone can start a stable credit union, we ought to make that easy to do. And I don't think we can speak as an agency about financial inclusion and about access and reaching the unbanked if we are making the de novo process 1 minute harder, 1 form harder, than it is. So I know the staff has done a terrific job of trying to streamline that. We're trying to make it easier. We're even trying to look at marrying a credit union that may fail merge with a group that is trying to start one up. But anyway, it is always a good day to have news of a new credit union. I would love to go up Pennsylvania and see those folks. And I think those who went through the process recently, or even those who tried and dropped out of it, will give us terrific feedback on how we can make this easier. So thank you again, Mr. Chairman.
Absolutely. And Board Member Hood, do you want to say something here?
Yes, I want to celebrate as well the fact that we do have a new credit union that's now going to be able to provide access to affordable financial tools and products and services. I especially applaud them going into that area where there are so many financial deserts that are in that surrounding area. So they have a credit union that's going to be able to provide services. One, it's critically important. I want folks to know that we want to see more de novos. We recognize it's important to have a healthy, vibrant system of credit unions who are there throughout the United States. I know nothing pleases me more when I got to visit some of the credit unions that got in charter. So the Vice Chairman, if you have a moment to go and visit them. You see the excitement, you see the energy. I recognize, as the Vice Chairman said, that we are losing credit unions, but I want the industry to know that we're not losing many of them because of bad performance or anything other than many of them just maybe have not looked at succession planning. Maybe sometimes many folks recognize that they need more products and tools in their arsenal to compete with some of the other financial services providers. So that's why I'm so keenly focused on innovation and access. I think that some of the fintech tools, if they are deployed with some of our smaller institutions, that will give them more of an opportunity to better serve their members. And again, nothing hurts me more when I read the list of folks that are not going out of business, but merging just because they've exhausted all other options. Let's give them options. So that means that the de novos do know that our agency wants to work with you, not just to approve the new charter, but to give you, whether it be coaching and mentoring and looking at opportunities to help you, whether you're an MDI, low-income designated credit union, or CDFI. We want there to be this wonderful panoply of great credit unions of all asset sizes and charter types throughout the country.
Thank you so much, Board Member Hood. That concludes our business, and I wish everyone a restful August. We will meet again in September. There being no further business, we are hereby adjourned.